We'll talk about your new report in just a moment, but I just want to get your broad thoughts on where we go here with oil prices. You do, of course, have an exposure to this sector.
Absolutely. Hi, good to be back. So on the oil prices, I think we have been very clear previously that we would expect markets to rebalance this year. That's what we see happening, and of course there's some geopolitical elements priced in. We'll see how that goes, but so far we content on how the market is trending.
Now, you previously, and a lot of people in the industry have talked about this already. You guys got this one, the outlook at least on oil and shale, quite wrong. But you also talked about taking your expertise there within the U.S. shale market and applying that elsewhere in the world. Can you talk a little bit about the outlook for that part of the business?
So we have looked at the shale business. Obviously, in 2010, we underestimated the supply opportunities. But at the moment, how we see the market is a very flat long-term cost curve on gas. We have been quite clear about that. But on oil, the combination of continuous decline in the resource base as well as continuous strong demand, we see an opportunity for additional oil to be induced between 4 and 5 million barrels a day, and that will continue to give a relatively sharp cost curve and therefore good margin opportunities for our really strong conventional business.
Arnoud, I want to continue with the shale story. I mean, BHP has talked about how it will acquire shale expertise from the U.S. and spread it to the rest of the world. Give us a sense of where you are with this. What are you doing, and how soon will this happen?
Well, what we did is early on, basically we did a shale endowment study, and we came to the conclusion that we don't see big shale development in the rest of the world continuing, and then that was a big driver for us to determine shale to not be part of our core business, and hence the decision to divest and split from our shale part of the portfolio.
Moving on to steel, we've seen some pretty much shifts within the steel sector in China. How do you see this playing out?
Well, what we are seeing on the steel industry in China has been extremely interesting. A trend which started many years ago, blast furnaces going bigger, going to the coast, and recently a stronger environmental overlay as well. In the last 12-18 months, that has been overlaid by the supply side reforms, a industry consolidation. The steel margins for the steel industry has been much healthier, and this drove and is driving a continuous demand for higher quality raw materials, both in coking coal and iron ore. This has resulted in much stronger price differentials, and as we will share again later today, we think these differentials will be sustainable for at least 2/3 of what we have seen last year.
So, Arnoud, what essentially you're saying that these major shifts in the Chinese steel sector will be driving higher demand for the high-quality stuff of iron ore. But when you look at profitability, though, across a lot of the steel mills in China, we're basically at half right now compared to several years back, which some of your rivals actually say the opposite, that this will actually drive demand for the lower quality stuff. How would you respond to that?
So what we have seen a steel industry which have been basically at zero profit or very low profit for many, many years. And only in the recent 18 months, on the back of utilization rates going back up to towards the 80, at some months 85%, we have seen a much stronger focus on productivity. We believe, and that's confirmed by our conversations with our biggest customers in China, as well as what we can read in the official plans from the Beijing government, is that a longer-term utilization rate of 80% is targeted as a sustainable rate. If you overlay that with the demand, productivity, and the environmental challenges, it will require coastal steel mills with inputs of higher quality, cleaner met coal and iron ore.
And talk to us about the broad implications for longer-term trends as far as volumes are concerned. Do you expect volumes to taper off, or do we essentially see the same level, say, 10 years from now?
What we see is that our steel outlook has been unchanged for many years. While we have seen the double digits growth behind us, we still see that there is growth for steel consumption in China, roughly 1% on a yearly basis. So a slow but sustainable growth towards the mid of the next decade, supported by Belt and Roads opportunities, which will increase steel demand in areas of China. Post that, towards the end of next decade, we see a slow demand tapering, both for steel as well as iron ore.
Arnoud, you talked about higher quality supply. What's the plan to bring on more higher quality supply, and how quickly can BHP do this?
At the moment, our target is to produce 290 million tons. We are on our way to do that. We currently have no plans beyond that. What is an important decision for us is that one of our resources, which is the Yenni mine, is coming to the end of life. So we have a decision to make to invest some capital to stay at our current production levels. We are hoping to take a proposition to the board later this year, in which we will approve, or where the board can approve, to invest in an area which is called South Flank. And the strength of the South Flank resource is that it is higher iron and more lump. So it plays well in the direction which we see in the Chinese steel industry, with higher iron ore, higher quality iron ore, and more lump, which will support the environmental agenda in China.
Arnoud, what assumptions are you making about steel prices?
We assume that steel margins will continue to be healthy, and probably at 2/3 of what we saw last year. Prices itself are a little bit less important for us. It's more the margins in the industry, and we expect to continue to see an industry which will further consolidate, have a utilization rate around 80%, and therefore an industry which will continue to be profitable.
Speaking of profitable, you talked a little bit already about margins here, Arnoud. Just very quickly here, give us a sense of where you think margins are going to head because of these sort of permanent changes within the Chinese steel sector.
We would say that margins in the Chinese steel industry will probably be on around the 5% level, which is where they have been traditionally been. They have for many, many years been to close to zero. But we expect sustainable margins between 4% and 6% going forward.